Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have Pete Kendall and Steve Hochberg of Elliott Wave International. Pete and Steve are experts at dissecting the structure of Elliott waves and forecasting the direction of markets. We're having them on the show at a pivotal time in history. The stock market is breaking down just as they predicted. We're going to pick their brain on what happens next and ask the questions that you submitted. Gentlemen, thank you for coming on the show.
Thanks for having us, Steve. We really appreciate it.
Thank you.
Yes. Okay, let's start out. This is your guys' first time on the show. Let's just give a quick, give your story and how you got into technical analysis and how that led to Elliott Wave International. Peter, let's start with you.
Well, I was a reporter. I was living in Denver, Colorado at the time, and they had a penny stock market, and I worked for a publication out there. I asked the question, well, if you just starting out, well, when you want to find out about the market in general, who do you talk to? And they said a few different people, but one was Robert Prechter. And I began to find out about the wave principle. And eventually, as I was in that role as a reporter, I became interested in the prospects for the economy. And in particular, the potential for deflation, which didn't happen for a long time, but that's sort of what got me into it.
Okay, and Steve?
Well, I graduated college and really didn't know what to do, so I talked my way into working for a major investment firm, but I was a retail broker, and I was probably the worst retail broker there was in the history of retail brokers. I was just not good at it, but I noticed that as I'm studying and reading the papers and looking at my Quotron back in the old days, there was this guy named Bob Prechter who in 1984 had won the United States Trading Championship with a 444% return in just a matter of months. And so I said, I got to figure out what this guy is doing because what I'm doing is not working. So anyways, I still worked for that investment firm for a number of years, went and got my master's degree. And then when I get out, I called up Bob and I said, I'd really like to work for you. I really respect your work. And he said, well, come on down to Georgia and we'll see what we can do. And that was the early 1990s, and I've been with them ever since.
Wow, so you guys have been doing this a while, and it sounds to me like what you're saying is basically you found what you found was the best guy in the business, and you made him your mentor.
That's exactly right. Yep.
Yeah. Okay. I've always kind of fancied myself as a bit of a chartist, and then in prepping for this episode, I realized how I got a lot to learn. Can you guys go over Elliott Wave Theory and just some of the basics, and that'll kind of set the foundation and the groundwork as we go on?
Sure. Well, let me share this screen with you here because this will be kind of a good starting place. Whoops. We'll go up to this one right here. Okay. Hopefully you can see this. So an Elliott wave is basically a fractal. We call it a hierarchical fractal. And it's just self-similar patterns at all degrees of scale. And really what we're measuring here is psychology as it moves from pessimism to optimism and back again. It creates certain patterns along the way. And this is what an Elliott wave looks like right here. And so you've got your basic 5-wave pattern to the upside, waves 1, 2, 3, 4, and 5, as you can see in the circle. And then notice that each of these 5-wave patterns subdivide themselves into 5-wave patterns. So within wave 1, you can see you've got a 1, 2, 3, 4, 5. And if you look within, say, wave 5, you can see a little 1, 2, 3, 4, 5. So there's self-similar patterns at all degrees of scale. And once you complete this 5-wave rally, you go into what's called a 3-wave pullback. And that's what we're seeing right here, ABC. Usually kind of bottom somewhere in the area of the previous 4th wave. And so this is the simple schematic. And the kind of gist of it is we can't absolutely know the future, but if we can figure out where we are within the development of this basic schematic, it implies something about the future. And so this is what an Elliott wave is, and this is the model that we use to judge where the market's going and what's happening in the future.
Okay, and so it's basically a 5-wave pattern up, a 3-wave pattern correction, and there can be little subsets in there, I guess, of each one of those. Right now, isn't there something like wave 3 is almost always the biggest wave? Is that correct? Or
Right. And so now we're getting into some of the guidelines and rules of Elliott Wave analysis. There's only really 3 rules. And the first rule is that wave 2, this pullback right here, cannot retrace more than 100% of this wave 1 that came before it. All right. So wave 2 can't retrace. It can't go below this bottom right here. Wave 3 can never be the shortest wave of waves 1, 3, and 5. And then wave 4 can never end in the price territory of wave 1. It can't overlap this high. Those are the only 3 rules. And if you can remember those 3 rules, then that puts you ahead of just about everyone else when they're following Elliott Wave analysis. And then we have certain guidelines, like usually within a 5-wave impulse, wave 3 is usually extended wave. It's usually the longest wave of waves 1, 3, and 5. It doesn't happen every time. Sometimes wave 1 can extend, sometimes wave 5 can extend, which happens a lot in commodities and precious metals. But usually in stock and stock indexes, the middle portion of the 3rd wave is usually the longest portion and the strongest portion of this impulse.
okay, so wave 2 cannot correct down below wave 1, right? Wave
Correct.
3 cannot be the smallest wave. Usually it's the biggest, but not always, but it cannot be the smallest. And wave 4 cannot correct below the top of wave 1?
Exactly. And those are the only 3 rules that you really have to know in terms of Elliott Wave analysis.
Okay. Now, I also remember reading something that I really like using Fibonacci retracement and Fibonacci extension. And so the 50% retracement, 61.8 seems to be the one that just seems to hit more often than not. Does that also apply in wave 2 coming down?
Sure. Yeah, it's applicable at all degrees of trend all the time. And
Okay.
so Fibonacci is kind of the mathematical basis for the wave principle. And it kind of guides us in telling us what to look for in terms of wave relationships and retracements. Because once they cluster together, for example, let's say you're into this ABC correction right here, this big ABC.
Yeah.
Well, we know in this pattern right here, wave C tends to be equal in size to wave A. And so if you can take this measurement and it also happens to be very near, say, the Fibonacci 0.382 retracement of this rally, you have a pretty good target of where this ABC is going to end. So that's kind of the methodology of how we apply it and maybe come up with some targets for where we think waves are going to end and new waves are going to begin.
Oh, I'm sorry. Where'd you say the 38.2? Where does that come from?
That would be up here. For example, if we take a Fibonacci 0.382 retracement, whoops, you go back of this entire rally,
Yeah.
which would probably be up in this area right here.
Yeah.
And then in this pattern, this is called a zigzag pattern. We don't have to get into that, but usually this wave C will equal wave A in size. So if you take this measurement and it happens to cluster near a 0.382, you have a pretty good target of where you think maybe a correction might end.
Okay. Yeah. I can see some of those in my mind right now. Okay. Did you have any thoughts or anything, Peter?
Yeah, I would say that to kind of bring it together and summarize historically, it's all the work. It's all due to the work of one R.N. Elliott, and happened in the 1930s. And all he did was look back at stock prices to come up with the model that we just went through. And it's important to realize that it is the Fibonacci ratio. It just happens to comprise it. He didn't know what the Fibonacci ratio was. Someone had to tell him what that was, and then he understood it better. And in fact, was able to apply it more generally to the culture at large, because if it's out there and it's guiding stock prices, then that's not the only thing it has to be impacting. It has to be getting out into the culture in other ways. And that's how we experience it as the 1930s, the 1940s, and the 50s. They all have a different tone, and that's due to the changing structure and the larger extra market aspects of the wave principle. So that's how I got involved with it. So first you had this Fibonacci aspect, and then there's this idea of fractality, where you have waves within waves. Again, something that Elliott didn't know about, but turns out in the culture, in the stock prices, and later is discovered as the idea of fractals. And that's a whole area of science now that didn't even exist when he came to the wave principle. So you see, it has some qualities that are unusual for a theory about how stocks move.
Okay.
That's what intrigued me, and that's why I'm here.
Interesting. Okay. Did you have another chart you want to share, Steve, or should we kind of go down the list here? What do you think?
Yeah, I can share one. I'm just going to show you. So this is a simple schematic, a hand drawing, if you will. But this is how we apply it in real time, in real life. Okay. And this chart comes from our newsletter that Pete and I just published last week, and it shows the price of gold from its late February low up to its recent high at 31.68. And so you can see this basic 5-wave pattern that we've shown in the schematic. Here's wave 1, 2, and then here's wave 3 that's longer than wave 1. And if you notice, wave 3 breaks down or subdivides into 5 waves. Then you had a 4th wave correction, and you had another 5th wave move. And there's some really interesting things about this chart, and it allowed us to call the top in gold pretty precisely here. Number one is this channel right here. This is called an Elliott Wave channel. And the way we construct it is we simply connect the endpoints of wave 2 and wave 4. Okay. And then we draw a parallel line off the top of wave 3. And usually wave 5 will end once it hits that top line of this channel. Now we had a rally, and it turns out that wave 3 of 5 hit it. And then we went sideways in this little triangle correction, and then we popped up one final time, and we tagged the top line of this channel. And that's when we knew that this rally was ending, because you had a beautiful Elliott wave. It subdivided, just as we thought. It hit the top of the channel. And not only that, but there's a Fibonacci relationship here between wave 1 and wave 5. Wave 5, in this instance, happens to be a Fibonacci 1.618 times the size of wave 1. So all we're doing is we're measuring this move right here, and then they're taking it, and we're times it times 1.618, and we're applying that to the end of wave 4, and that's where we got this almost exact top measurement for a high. So this is what we do in real time, and this is how we apply Elliott waves. And this turns out was a really good call, because gold has come down much further since we first shown this chart. So this is one real-time example, and another one that I just wanted to show, which we showed at the end of our letter, was the stock of a Walt Disney Company. This also has just a beautiful Elliott wave in here. Now, Elliott waves don't always show up that clearly in stock prices, individual stocks. It's more stock indexes and widely traded assets. But sometimes stocks will show clear Elliott waves, and this is one that was just too good not to show. In fact, we showed it a little bit earlier in our newsletters. I'm not sure the exact date, Pete. You might know that, but we're updating it as we go forward. And you can see from the 1974 low, you just had this beautiful 1, 2, 3, 4, 5, and each of the subwaves subdivided into 1, 2, 3, 4, 5. Wave 3 is the longest of all these waves. You had a 4th wave correction, and then finally a 5th wave move up to a high. I believe 2021 is when Disney peaked. And now we're starting a downtrend coming off that high. So this is another classic example in real time of what an Elliott wave looks like and how we apply it in terms of our analysis.
Interesting. Okay, so it would be much more applicable to the S&P 500 or the Russell 2000 than it would be to my junior gold mining stock.
It could be. I mean, there's sometimes when there's a highly emotional content involved in, say, a junior mining stock, where it will trace out clear Elliott waves. But most of the time, it's in broad stock indexes that we find the clearest patterns. But anything that has that's freely traded with high, emotion, high volume, you're likely to see Elliott waves show up in that.
Interesting. Okay. Okay. Do you have anything to add here, Peter?
Well, I guess again, my role here would be part of the we call it the pop culture section, and so all of this stock, Walt Disney, has implications about the culture at large. What's happened to Disney in the recent past is a story of political polarization, movie sales declining, some of the iconic bull market imagery that we have dates all the way back to the beginning of the bull market, and Disney was actually a big player in that as well with cartoon movies, which is very much a celebration of the early part of the bull market, really. And then it changes over time. Disney over time becomes largely a different corporation. But I guess our point here that we made, we're going to be watching Disney to see how it transpires over the course of the bear market, because it will be very difficult for it to apply its prior role as an avatar of the culture in a different culture. So it's going to be interesting to see what happens with Disney as we go forward.
Yeah, Disney's a really interesting company, simply because it really is a bull market icon. If you remember back in here in the 70s, when we were in a actual bear market that actually ended in the early 80s, right around here in the Dow Jones Industrial Average, Disney stopped making, I believe, Pete, if I'm correct, they stopped making their cartoons because they just weren't selling. And it wasn't until the bull market started moving back in the 80s, I believe 89 was their first reintroduction with Little Mermaid that came out, which was in the middle of this third wave right here, when they started making their cartoons again, and their popularity soared after that, as you can see from their stock price. And so being a bull market icon, I think as we go through the bear market, it's going to be interesting to see if Disney falls off like it did in the 70s, or they're able to adapt in some ways to the new environment that's going on. And that's something Pete and I will be looking at as we move forward.
Yeah,
okay.
we would say that in the 90s, the culture returned to the one that Disney was so dominant in, to a certain degree, to a large degree, and it regained some of the popularity, the family imagery that was so popular in the 60s was again in the 90s, and that was a third wave. So it's hard for it to recapture that, because that sentiment within the society isn't there. So it's going to be interesting to see how it plays out in this new bear market environment, where it's really absent to a larger extent.
Okay, so you see an ABC wave correction coming.
Yeah, yes. Yeah, and we're going to be going down, we think, a pretty good ways, not only in the market, but also in Disney's stock, simply because from an Elliott wave perspective, they've completed 5 waves up. And when that's done, you're probably coming down into this area here or even lower. So we'll see.
Yeah, we made the comment in the newsletter that misery and failure are created by trying to live in an old trend when a new one is in force. And for Disney, it's hard to be in a new trend when it's, horror movies are the thing. Can it reshape itself to take advantage of a difference in the culture? And that's what we're going to find out.
Yeah, interesting. Okay, let's see. Daniel has a question about, he says, what are a couple examples of Elliott Wave principle guidelines versus a set of rules?
Okay, so in terms of guidelines versus rules, the rules are just the 3 that we talked about earlier. That's really it. Those are the 3 rules. There's multiple guidelines though on how waves form, and so I can't go through all the guidelines now, but just on just basic formations that guide us to try to ascertain where we are. So rules are absolute; they can't be violated. Guidelines are suggestions, but in our view, they're strong suggestions. You shouldn't really violate a guideline if you don't have to, but you cannot violate the rules.
Okay, all right. Would one of the guidelines be like, I watched just a quick YouTube video on this, and it showed it in like a diagonal trend line, the Elliott wave going up. and it said sometimes wave 4 can drop below wave 1, but only if it's in this diagonal trend line. Is that sound
Well,
right?
that's a specific pattern called an ending diagonal. And in an ending diagonal, which is a specific fifth wave, wave 4 has to overlap the top of wave 1 simply because of the nature of what that specific pattern is. But for example, like a guideline is, there's something called the guideline of alternation. And that means that if wave 2 is a sharp retracement of wave 1, wave 4 is likely to be a sideways move. In other words, alternating between the sharp retracement of wave 2. If wave 2 is a sideways move, wave 4 is going to be likely a sharp move. So those are the types of guidelines that we're talking about, guideline of alternation. So we're always looking for that to help us assess where we are within the development of the pattern. So if we know that wave 2 was a sharp retracement, and wave 4 is just starting, and we don't quite know the pattern that wave 4 is going to take, we do know that we should be looking for more of a sideways move than a sharp move. So that's very helpful in our analysis.
Yeah, that could kind of dictate between maybe we'll just ride this one out instead of selling and waiting for a correction and then getting back in or something.
Right. It gives people kind of a guideline of how a wave might unfold. Yeah.
Yeah, or running a put or not.
Right.
Okay. Ride wants to know. Says it sure looks like the stock market is in the third wave of a downward impulse wave. Can you share what you think? Can you share where you think we are in the wave structure and where you were expecting a bottom to form? Okay, I can pull up the S&P 500 here if you like, or if you guys have a chart.
I would like you to pull that one up, as a matter of fact.
Okay. Consider it done. All right, here's the S&P. Let me get rid of the RSI and MACD. Okay, this is monthly chart, so you tell me where you want it to go from here. Should I zoom in or?
Oh, actually, I was speaking. This is actually perfect. So there you have it, and we can talk about it. Steve, I'm sure you can find 5 waves up on that chart. I was going to look at the one on our current issue, but this one's good too. You can see the 5 wave rise from. Sorry.
Is this from are you talking from 2009 or am I going? Yeah. Okay. All right. So I'm going to just do a dot here. Okay. Is that one?
One is actually a little bit lower than that.
Okay. All right. Let me see here. So we go there.
Can you put this on log scale at all, or?
Oh yeah. All right. There we go. Log scale. Okay. So this right here is 2009. Right. Should I back this one up a little bit, or what?
You can start there. So you basically have. The one is at the peak prior to that, but that's okay.
See,
it gives you an idea.
Oh, right here. Okay.
Yeah. It gives you an idea of what it should look like, and then the 3 at this degree is actually all the way up at the 2022 high.
It's a long third wave.
Oh, okay. All right. Let me start over here. I'll just do
there.
Individual lines. Okay. So we got from here to here.
Yeah.
That's one, right?
Right.
Okay. And then down right here, this would be the retracement down to there.
Right.
Okay.
2. And then you've got a long, elongated third wave up to the 20 right. And
that's
then you've
2021.
Yeah.
Okay.
And then the fourth wave down to there, and then the 5th wave up.
Huh. Okay.
Now each of these subdivides into 5 waves, but we don't have to really get into that at this point. But let's go to
the issue, page 3 on the left at the bottom of the page.
Let me go to the issue here.
This will be a picture of another fractal.
Page
the most recent one
on the left. This one right here.
Right.
Okay.
Yes.
Oh, there we go.
So, Steve, tell us about this. I did not see this picture until the issue was done, and we had it all together, and then I looked at it. But I would like Steve to tell us about it.
Well, this is just simply the NASDAQ 100 from its high in November of 2021, which was the end of wave 3. And then we have this correction, this zigzag correction that we called it, down to wave 4 in the late 2022. And then we have a 5-wave rally all the way up to the high that just occurred on February 19th. And you can see how each of the subwaves subdivides into 5 waves.
Okay.
And bringing us culminating into a February 19th peak. And since then, we've had a very steep drop where we've closed below the wave 2-4 trend line
Show
there.
this. Okay, roll up and show the bottom of the page. It's an S&P, but you get the idea of a smaller wave within it
Okay.
that's completing. And this is
Right.
the
So this is even a small. This is the fifth of the fifth wave. So we're zooming down from going from a weekly chart now to a daily chart, and you can see the 5-wave pattern up into wave 5, which topped on February 19th. And then we traced out wave 1 down, 2 up, and now we're in a third of a third wave to the downside.
Okay, so that's basically what
my
he's...
comment is one about Elliott Wave. It's a visual thing, and I hadn't seen it when we were putting the issue together. And then I did see the issue when it was there, and I was like, oh, wow, that's a very compelling pattern, is all I'm trying to get to. Sometimes you have a little more confidence about the pattern and whether it's where you think it is. And I would say right now, I feel confident about that pattern.
Okay. Okay. And so that's basically what he's asking. It looks like the stock market is in a third wave of a downward impulse. And that's kind of what you're seeing here, is that it's forming up the third?
Yeah, I was trying. That's the answer to his question for me, is the look of that.
Okay. Okay. So
And if you were, I guess if you do it for not that long, I think you might agree that that's a compelling pattern.
yeah. And so is this part of the A, B, and then C pattern down? So this would be the C part?
Well, yeah. So now we're talking fractals here. So there's self-similar patterns at all degrees of scale. This is a very small degree scale. So we're just in the early part of that wave A.
Oh,
So you're going to trace out 5 waves down, and then that will be the wave A. Once you trace out 5 down, and then you do a 3-wave rally, that will be the wave B, and then another 5-wave decline would be wave C. But we're just in the very, very early stages of this, so it's still got a long way to go before we get that whole correction complete.
oh, how exciting. Okay,
Yeah.
I know we're just pontificating here, but how once we get down here, what do you guys see could be the bottom here in the S&P?
Oh, I think you're getting a little too excited. And I say that because I was watching when Steve was talking about the gold chart before, that was the last fractal. And I remember when that thing was getting going in 2023, and it was a much harder process. I mean, it's a little easier now. It's happening fast, and it could be over. We're not sure, but it looks like it is, and it was pretty. But when you're getting started on these things, they're hard. Now, this looks pretty convincing, but just so you know, it doesn't always go as smoothly as it seems.
Yeah, I would, and we don't. I mean, people always want to know numbers, and what's your number? It's just a number, because you really don't know until the pattern unfolds. And then once the pattern unfolds and we see where the structure is, and we're able to maybe take measurements based on the degrees of waves, then we have a kind of an idea of where we're going. But I would just simply say that we're nowhere near a lasting low. I mean, we could be coming toward an interim low, but it's not a lasting low based on the larger degree pattern of the 5-wave move into the high. So we've got a long way to go on the downside, and that's where our perspective is right now. We're bearish the market because things we haven't completed on the downside what we're looking for.
Okay.
I would say from a very near term, the thing that has really been kind of mind-boggling to me is if you read our newsletter, you would find a great deal of number of articles about the retail investor and his interest.
Yeah.
And I was surprised. It went out and the market got hammered again on Friday of last week. But there's still these stories about the retail investor and people who ran into somebody over the weekend and how happy they were about this sell-off, and they were going to take full advantage of this greatest opportunity of their lifetime. And I'm like, that's bizarre behavior that does not suggest a low at all.
Yeah, I'm gonna share a little excerpt here. It says from your newsletter. It says basically it shows how willing individuals are today to ignore their own negative sentiments toward the market and stick to the buy and hold no matter what philosophy. And then later on, this floored me. The largest 3x levered fund is the ProShares Ultra Pro QQQ. That'll probably change in the future, which increased 150% from 7.8 billion invested September 2021 to 19.6 billion invested the first of this month. So, man, that's surprising to me.
Yeah.
But
yeah,
you know.
that's a good point. On top of everything, there's this leverage that if people are still solidly confident, they probably haven't abandoned those leverage positions, and when they do, then there's going to be some interesting activity in the market as well.
Yeah. Okay. Alrighty, that hit Ride's question. Now, Tech Solution wants to know, says, how do you determine an entry level when the correction was overly complex with no clear subwaves to indicate that the correction is over? I'm not even sure I understand the question, so can you guys break this down for me?
Yeah. I'm not quite sure I quite understand it also. I think he's just asking if it's a complex correction, what are signs that it's complete? Well, usually what we do is we drill down to very small levels of the pattern. You might be looking at a daily chart, and then you go down an hourly chart, and then a 15-minute chart, and then a 5-minute chart. You're just looking for waves that look complete. And when waves are complete, then the trend is usually going to reverse in the opposite direction. And you're going in the opposite direction when you see that initial small 5-wave pattern, that what we call an impulse. Once we see that initial impulse, we have a pretty good idea that the trend is reversing. So we're looking for targets, we're drilling down on wave structure, and when they all kind of come together, it's a pretty good indication. Even though the correction may be complex, it's a good indication that you're probably at a trend reversal point.
Okay. I would say this is just in general, speaking from more the perspective of the neophyte Elliott Waver, that they sometimes get frustrated with corrections because they don't act like impulse waves. Impulse being the wave in the direction of the main trend. It could be up or down, and then when things are going against the trend, it can be squirrely and hard. And I can really remember when I was first learning about the wave principle, and someone asked an expert on the wave principle about corrections, and with a level of frustration, the expert became a little bit uncomfortable, lost patience a little bit with the would-be Elliott Waver, because you just have to put up with that. It's just not as pretty and precise as an impulse wave. So, it's just not perfect. I mean, it is perfect in its own way, but it's just frustrating for the person trying to pin things down.
Yeah, and I think Pete brings up a good point in this regard, and it's kind of a corollary. Is like, you don't have to be investing or trading everything all the time. If something isn't clear, then don't worry about it. Look for a pattern in a market that is clear, because there's tons of them everywhere. So if you're uncertain and you're just not sure, then turn to something that you're more confident about.
And
okay.
Yeah, by the same measure, let's talk about tariffs for a second. If you read our stock section, we haven't talked about tariffs almost at all. I don't think we even mentioned the word tariffs. And that's because it's technical in nature, and we don't need to worry about tariffs. It's not that we can't account for it, and we won't. We'll have a good idea about it, but we don't have to second guess. What does it mean now that he's changed the tariff? It's going to be like this for a long time, and it's wonderful to be able to have our bearings amidst it.
Yeah, that's one of the things I love about technical analysis is you can kind of, I don't want to say you completely ignore the news, but I just look at the charts, and they give you the answer. It's another thing you mentioned that I think rings home with me is you mentioned going down on smaller and smaller time scales, especially when I'm looking at a company that I've never seen before. I always start with the quarterly, then I go to the monthly, then I go to the weekly, daily, and I work my way down. And especially when doing options, is I'll get down to the 1 minute, because even if I'm doing an option that's got a 6-month expiration on it, I want to get big picture, and then I want to get down to the nitty gritty 5 minute, 1 minute, and be like, okay, I'm going to pick this little double bottom here, and that's where I'm going with it. And it sounds like you guys can kind of do the same thing with Elliott Wave, getting down smaller and smaller time frames.
Right. And it's okay if you don't pick the bottom. It's okay if you you miss the first X percentage of a move, as long as you're confident in what you're seeing in terms of the pattern. There'll be other opportunities as it unfolds in the future to try to position for whatever you want to do.
Yeah. Okay. Nautica wants to know, he says, where is the following ratio going? I can pull this up on the chart here. The Dow-Gold, and let me share my screen here, and I already had it set up. Okay, so this is the Dow Jones divided by gold, or this is gold divided by the Dow Jones, whichever one you guys want to pick.
Yeah, this looks like it's the opposite. It looks like it's gold divided by the Dow.
Okay, I can do Dow divided by gold then. There you go.
Here you go.
They're just an inverse of each other, so whichever way your brain works.
Yeah, you got it.
Okay.
So if the Dow or the S&P or the stock market was valued in terms of real money, this is what it would look like. And instead of denominating in nominal terms, which is US dollars. So basically in July of 1999, you could have bought the Dow, or it took 44 ounces of gold, right around there, to buy the Dow. And today, as you can see, it takes about 12.76 ounces of gold to buy the Dow. So what's happened is we've actually had a bear market since the 1999 high in terms of real money. In other words, the nominal Dow has gone up to 36, 37, whatever thousand that it's trading at, but your purchasing power, as you can see in this chart, has gone down.
Yeah.
And this is actually one of the most important charts that you can look at when trying to ascertain what's going on with the market, because you can see it's just the inflationary, the devaluation of the US dollar is what has caused prices to go up, including the Dow Industrial Average. So if the Dow was denominated in real money, there would be no question that we'd be in a bear market. In fact, we're down, I think it's about 70% from the high back in 1999. So this is an important chart for our, about
71. Yes.
71%. So this is an important chart for our measurement and our valuation. We look at it a lot and keep an eye on it. So that's what you're looking at here.
I think it explains a lot in terms of the dichotomy between the some aspects of the economy and where the stock market is. If you look at the nominal, in nominal terms, hit a new all-time high in the S&P in February. But if you look at the global political picture, for instance, you see a world that's not where it was in 2000, which was the peak of a third wave in Elliott Wave in our terms. So what's the difference between 2000 and now? We see it in many different formats. You see a polarization politically, particularly on a global scale, where we have actually a war and versus really a very peaceful environment in 2000. So what is all this global tension about? We think it's about this index and how it's actually down broadly at this point in time, and that it's materializing in other ways as well. So that's, politically, you see it in this country where we have a polarization, and in other areas.
I bring this chart up on my weekly recap every week. I compare gold against a lot of other things. So like you guys, I look at that as real money. And this is gold divided by the S&P 500. Now, I've heard a lot of other technicians talk about this 50% line rate here, and we finally convincingly broke out of this. Do you guys put any stock into this chart, or do you not even look at it?
Well, we look at it the opposite. We look at the S&P divided by gold, and it not so much the 50% level. What we're looking for is just patterns in Elliott waves and so forth. So Yeah,
There
go
we
ahead,
go.
Pete.
And the difference with the nominal Dow. So in real terms, the Dow peaked in 2022. Very important. Yeah, very, very important.
Okay, so here's the S&P divided by gold. So basically the
Right. So what we're looking at is if you look at the top there in the upper left, the peak, there's a pretty nice Elliott wave to the downside to the low that we had in 2011 or 12.
Oh, okay.
That's a third wave. You move up at a fourth wave and you come down to the low. So that's a 5-wave decline.
Okay.
And then we've had from that low, we've had a very nice ABC rally. Yep, you could do that. There you go. Right.
There we go.
And then
And then going
the A
up,
wave,
ABC. This is my first time using this on this software.
That's
so.
fine. So the A wave is
There
all
you
up
go.
to the
Keep
next
going.
high. Next high.
Oh, next
is the
high.
A wave.
Damn.
Yep.
Hang on. Let me close it out. So this is going here.
Yeah.
Here, there,
Okay.
right? And then B wave, and then you had the C wave to just above, right there, the A wave high. Now, in this case, the A wave is the elongated wave, but that's fine. This is called a zigzag upward correction.
Okay.
It ended in the right near the high of wave 2 or close to it.
Okay.
And so, I mean, to us, it's not so much the 50% retracement is like, what's the pattern look like? And this pattern is pretty clear to us. We're pretty confident in it. You got a 5-wave decline, a 3-wave rally, and we think we're going back down in terms of this ratio.
So you can have a 5-wave decline followed by an ABC correction up, and then a 5-wave decline. So it goes both ways.
Right. So,
Yeah.
what
That's
if you think back to the schematic that we had earlier, this 5-wave decline that you drew on this chart, that would be the A wave. The end of that would be wave A. A bigger wave A. The ABC would be the end of wave B.
Yeah.
And now we're going to do another 5-wave decline, which will be wave C.
Wave C. Okay.
Right.
So it's the same as in the Dow theory, the primary trend.
Right.
Okay. Okay. Interesting.
And in fact, Elliott was aware of the Dow theory. So he built it from the Dow theory.
Okay. Okay.
He had that in his mind.
The Dow divided. So we're back at Dow Jones divided by gold. So, I mean, we had a historic time back here in 1980 where you could trade 1 ounce of gold for 1 share of the Dow. I mean, it could get crazy, right?
Well, yeah. I mean, the interesting part is if you look at from this high in July of 1999, if you compare the returns on gold and the returns on the stock market from that point in time to the recent highs that we just had, you know, gold's up over 1,000%, and the Dow Jones Industrial Average is up about half of that, 500 and some odd percent. So gold has actually outperformed the Dow in nominal terms from that peak in the Dow Gold ratio. I mean, the gold has outperformed, which is really fascinating. I mean, it's because you know, people think gold is a relic, but it actually has had a better return than the nominal Dow because I think the purchasing power has been eroding. So, anyways, it's just a little statistic to throw out there that people should remember.
Okay. Awesome. Nautica, excellent question. Thank you, sir. Okay. He's also asking, how low will this current correction in gold and silver go? I can pull up the gold chart here.
Well, I think our answer is kind of similar to the answer it would be for the stock market. It's all going to be dependent upon the patterns that trace out, and it's kind of like we'll know we're near an end when we're getting close.
Okay.
Because the patterns will be fully formed. You'll have so much pessimism out there. People will tell you don't ever want to hold gold again. It doesn't do anything. Don't worry. You know, those are the types of psychology that we're looking for to help us assess the pattern as it goes down. You know, how low is this going to go? Well, it's going to go a lot lower than it is right now. I mean, it's probably the easiest answer, even though it's maybe not as satisfying to some, because people just want numbers. But we're just starting the decline to correct the entire gold rally from 1970. So we've got a long way to go to the downside.
Okay.
Now, let me put a little caveat. Having said that, I think on a relative basis, gold will go down less than the stock market. We're really, really bearish on the stock market. We're bearish on gold, but not to the extent of U.S. stocks. So So on a relative basis, gold still has value. It's just going to go down just like the rest of the market. If you remember back in the Great Credit Crisis, back in 2007, 2008, 2009, gold went down 40% in the middle of 2008 with the stock market, as both of them, we were fighting deflation at the time, and both of them were going down pretty hard. But then gold bottomed and started rallying while U.S. stock continued lower. So it could be a situation like that this time around also.
Okay.
I have a question. Did sentiment in gold get as extreme as you would have expected? If that was a high in gold, do you think sentiment was as extreme as it will get, I guess?
Yeah, I thought sentiment got up there. I mean, if you look at the commitment of traders data, large speculators were over 50. I think they were 52% long total open interest in gold. That's pretty high historically.
I will give an answer, which is I thought it would get higher. I thought, for instance, that silver would have a day at least, where it was the metal, and gold, everybody would be going, "Oh, gold sucks. We need to own silver," but that didn't happen. So I don't know what it means. It's
a huge bearish divergence where, gold is, it went to 850 in 1980, and then all the way up to 3168. Silver peaked in 2011 or in 1980 at $50 an ounce, and then in 2011 they couldn't even take that high out. And then I'm looking at spot prices.
This is spot price.
Okay, then there's the future price that came just underneath it. And now look at the divergence between gold's making higher highs and silver's not even above its high in 2011. So, I mean, it's a pretty big bearish divergence.
Yeah. Right. This is log scale too, so it's a little off. There we go. Okay. All right. So we still got a correction to go, you think, in the metals, and that if past is prologue and, history rhymes, then that's exactly what's happened before. Gold and silver do exactly what they're supposed to in a liquidity crisis. They act as real money. People sell what has a bid, and those two always have a bid, but they should correct sooner and rebound faster than the general market.
Mm-hmm. Yeah, on a relative basis, they're going to hold up better than the stock market.
Yeah. Okay. Mr. King is asking a question, and so crude oil. So I've been pulling this one up for a while on the charts here. And so I drew this $67 mark. I've kind of moved it between 67, 68, and 65 now for the last few years. And this is, he's asking this question, and so am I, do you guys see any relevance here in I feel like from back here, crude came down and it tapped the line and then went up and tapped the line and then went up higher, and it kept making lower highs but hitting the same mark. I kind of look at this as a technician, almost like there's a soap bubble there or a balloon that's bouncing a pin, and the more time the pin bounces on it, the weaker the balloon gets before it finally breaks down. And after talking about this for 3 years, it happened. I'm not sure if I'm just lucky or if there's any validity to that, or what. Do you guys have any thoughts on that?
That looks right to me.
Yeah. Usually the more time you test support or resistance, just talking technical analysis, the weaker that support and resistance gets. So the fact that you've tested it so many times, it was bound to break. Okay.
I've heard both arguments, that the more times it tests it, the firmer it gets, and I've heard the more times that it tests it, the weaker it gets. And I've kind of been in the weaker camp, and I'm.
Yeah, I mean, it depends on where you are within the development of the move. For example, if you've already had a 20% decline, and you're testing a basing area of support, well, that the more times it tested, the stronger it gets. But if like oil, you went up to 130 some odd, and then you've come down and you're still way above where it was 6-7 years ago, then the more you test this support line, the weaker it's going to get.
Okay. All right. Okay. So that. And
so that's another thing about Elliott. There's more than enough room for all of these things. And we frequently talk about standard technical aspects. Every month we cover something or other.
Yeah. Okay. What are your guys' macro thoughts on crude?
I think in a deflationary environment, which we think is the ultimate outcome of where we're going, the crude oil is probably going to go down. Just because
it could hardly be tested by international tensions more than it has been in the past 6 to 8 months, so, or more longer than that, actually.
And it's still going down. So, I mean, it tells you something.
The decline has proved resilient, let's say. Not that not that there's anything to that, because we don't harbor fundamental aspects, but it is happening, so we're not going to discount it.
Yeah. I'm getting kind of excited for companies like Exxon. You know, they just seem to be getting cheaper by the minute, and at least from I'm kind of a Padawan of Rick Rule, and he's like, these companies aren't going to make much money at $55 oil, if any. You know, so it can't stay down here too long. But it seems like they're getting cheaper and cheaper.
Yeah.
Okay. And he also wants to know what charting software do you use, and do they have any Elliott Wave models built in?
It seems like every charting software has some sort of Elliott Wave model built into it, but we have not found any that are reliable enough to use. You've really got to do it yourself, and for a couple of reasons. One, that's how you learn, is to label the chart yourself. If you just click on whatever button you have on a software, it puts labels up there, but we find that they're not reliable. Nearly all of them. Because they're looking at like a momentum extreme, and they're always putting a third wave on it, but that doesn't always happen. For example, in commodities, your momentum extreme is going to be in your fifth wave, not your third wave. So that's just the insight. But there's some great charting softwares just in terms of what to use. Personally, I've used CQG since the early 1990s. There's a great charting software called Motive Wave that a lot of other analysts at our firm use. And then there's the big ones like TradeStation, and they've been around forever. But there's some great charting softwares out there, and just use one that you feel, you can afford and that you feel comfortable, that gives you a lot of flexibility so that you can do your own wave labeling as you're looking at a chart.
Okay. You mentioned, this is the second time you've said it, is that commodities tend to have the big move on the fifth wave cycle as opposed to like the S&P. Can you go into that?
Yeah, and the reason being, as you think about it, is the emotion that propels a fifth wave in commodities is one of fear, whereas the emotion that propels a fifth wave in stocks is one of hope. You're hoping that earnings are going to increase, you're hoping for whatever, whereas in commodities, you're usually fearful because of shortages, weather conditions, or whatever. So fear is a sharper emotion, which is why the fifth wave tends to be sharper in a commodity than it is in stocks.
You have a great example of this in the latest issue. I happen to realize as he was saying that, because we have the stock market, and in this issue, we characterize it as a 4-year process, really, from 2021 to the current point in time. It's been a remarkable. People will be talking about it for the rest of their lives. What took place over those 4 years in the stock market.
Which page here, Peter?
Well, let's see. I would go to the bottom line, actually, the very top, and you'll have our bottom line forecast.
Magnificent, no more.
Keep going all the way to the very top. The bottom line is right there. The major U.S. indexes are all aligned in across-the-board plunge. So that's our stock forecast.
Across-the-board plunge.
Yeah. What's interesting is if you look at some of the secondary indexes, they're really down more than the primary indexes. For example, Russell 2000 peaked in November last year, down over 25%. Same thing with the value line geometric, the value line composite, which is measures the median stock performance of the average U.S. stock. So
here's the Russell. Yeah.
Bam. So they're all aligned. I mean, they're all aligned now. And what was interesting is that the topping process that we had was very drawn out, which is typical of stocks. Whereas one index would top, for example, we talked about the Philadelphia semiconductor index, the SOX, and that topped in July of last year, preceding everything else. And so stock tops tend to be diffuse because the emotion that drives a fifth wave, which is hope, dissipates diffusely over time. Whereas in commodities, like we said, it's fear that's driving that fifth wave. So it tends to be very sharp. It spikes to a top, blows off, and then it reverses in a very sharp manner. But, I think
so by contrast, the gold forecast in this issue is, now, and I guess, we didn't make this point in the letter, but I guess we would say it has a better chance of happening faster than the stock top, which will, at this point, it could happen fast. It's already taken 4 years, so its time is in, but it would be interesting if they both proceed apace right now. We'll see.
Yeah. Okay. Always interesting. Always interesting. Well, thank you, gentlemen, very much. You guys have a free gift for everyone watching the show. Go ahead and tell us about that. Tell us what viewers can expect if they sign up for your service.
Yeah, I think there's a link that you have that's www.elliottwave.com. It's 2 L's and 2 T's in elliottwave.com /in-it-to-win-it. And we're offering the financial forecast service for $11 to try it out, which is the newsletter that Pete and I write every month. It also includes the Elliott Wave Theory, which Bob Prechter writes, and a 3-time a week update every Monday, Wednesday, and Friday after the market closes, which I write to give us an update between each issue of the newsletter. So plus there's a tons of other free stuff on our website, great charts. I mean, it's just a great place to click around and give us a shot and see if there's something that interests you there.
I don't remember what it was. It was $11 or something. It seemed like a really good price. It's elliottwave.com, in it to win it. Yeah. INITTL, win it. Hope you'll check it out.
Yeah.
Awesome. Well, thank you guys very much. I got a copy of it, and it's very, very in depth, and but also very easy to read. So thank you guys for coming on the show. You have a great rest of the day.
Thank you for having us. We really appreciate it.
Yes, and thank you for tuning in. Be sure to check out your free gift in the pinned comment below and down in the show notes. Click on that link and it'll take you straight there. Thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.